Hi. So hopefully you can hear me and we're off and running. Well, usual nonsense. I think we've got rid of the gremlins. So how is everyone? That was a bit of a strange weekend, wasn't it, with Mr. Trump and all the shots ringing out. It's a shame about England. Well done, Spain, on both accounts. Well done to Bob McIntyre, the first winner 25 years of the Scottish Open, second only. And Julie, you're there, you'll be happy about that. Bob McIntyre coming down the last birdie to win. He needed to make up three shots. That was the best British performance yesterday. Awesome stuff. So, what do we all think? I mean, I know some of you are expecting more fireworks with the Trump fallout, but it doesn't feel like it's had much of an impact yet. People still digesting what it really means. Obviously, his approval rating went up. We haven't had the bond panic like we had the other week when Biden was really struggling. Perhaps people are coming around to the fact that Trump's in the lead anyway, and that the Democrats need to do something radical. But like I've said before, I'm not as convinced as these Nobel laureate economists are about just how inflationary Trump will end up being. He's not totally stupid, and you might think he might come out with a slightly less crazy fiscal side the nearer he gets to taking power, but we shall see. As I pointed out, the big thing overnight really was the Chinese data. That seems to have taken over what the markets are thinking. Oh, Bob's from Argyll and Bute. Brilliant. So it was brilliant watching all the Scottish people really, really getting behind him. It's a fantastic eagle that he pulled out. So yeah, the Chinese data really is the thing that's got everyone a little bit on the back foot. We said it months ago. The danger for the markets, the Fed waiting, is that we suddenly end up with a load of deflation exported. That's when we will see everything coming off at the same time, like it did in 2008. Eventually, the inflationary policies to bail us out got commodities going, but that was a market where everything sold off to start with until people understood what's happening. And there's this thing called the third plenum in China, which I don't fully understand the meaning of it, but it's basically to do with their 5 yearly, half-decade yearly updates on their policy. They don't like to have lost face in the previous one, so there'll be some humble swerve about what's going on, but net, they're going to have to come out with some pretty aggressive bailouts, which would help. But at the moment, they've got the currency under pressure as a result, flight to quality, so they didn't cut rates this week. So it's another issue with, we talked about this a few weeks ago, the US does have to think globally a little bit soon, because if they're not careful, they're causing lots of other issues around the world. The currency pegs are really pushing to the downside again. It's causing all sorts of issues in the emerging markets. That would be another reason for slight sell-off, and the fact hidden within all that Chinese data is the imports side of it. That is both the oil demand is down, which could be a reason why that market tops out again. So we had all the updates, which I mentioned in today's preview, suggesting that demand was a little bit higher for the rest of the year. Well, that would be a curveball and a reason for oil to potentially top out soon. If Chinese demand doesn't come back, it also means if they're not importing, they've not got domestic demand, then the economy is skewed to exports, which again, they could really have a problem with a trade war. If that escalates, then that could end up with some marked consequences. I think the net of it is they'll find a way of exporting that deflation, those low prices, just to clear the inventories and try and keep their economy bobbing along. So America needs to be careful what they wish for. And a little rate cut boost again is something that would help all parties. So you've probably not had enough time to go through that preview. Are there any questions that you've got or anything you've seen yourselves that you might want to talk about? Because it's raining in London, is it? Is that what that means? Or Hi Bletchley, hi Pav. Um, so Biden seemed to manage to get through the weekend without messing up any of his sympathy interviews. But next against the Democrats, I think it was 213 for and 18 against going into the weekend. Um, so it's still there in the background as an issue. So it was interesting. A couple of people were talking about Orban. Obviously, they're the EU presidency at the moment, so they've got lots of excuses to talk to world leaders. And he's been speaking to Z and Zelensky, and he's known to be a confidant of Donald Trump. So that is probably where the brokering of a deal is being done. Trump is so infamously saying he's going to get done with one phone call. Um, so I was listening to some preeminent bond traders. That's right, Vice President Putin. I sent out that meme about the spitting image from on Friday, how history rhymes, where they were taking the mickey out of Ronald Reagan, not remembering who everybody was, and effectively making the head of Russia his vice president, and then a stuffed chimpanzee that he used to star in films with. And it's all comically going along the same stage lines, isn't it? I'm sure it'll sort itself out. So the bond situation is interesting. I think it's interesting that we haven't moved overnight. So you need yield support to encourage investment. The bond market tells you whether things are really going to be inflationary or not, and they seem to have decided that it isn't at the moment. They're back to all the auctions, rates coming down. There's a chatter that the money market funds are coming out and they are buying down the curve. In fact, the 30-year yield was below the 2-year today, I think, which is a sign that longer-term inflation fears are easing. But the inflation figures from Michigan after we had the Friday live, they were more or less in line. I think there's some people talking about there's some hidden parts of that which we don't normally look at, which is slightly worrying. But I think we'll stick with the headlines. And that survey was taken pre-CPI, so it's good that they're already looking at the inflationary impact coming off. The sentiment surveys were down. Now, this is the thing that will be getting the Fed worried, because you'd have thought that with inflation expectations coming down, people would have come off these lows sentiment-wise, but they're not. And they're all citing the fact that prices have just got too high, which is the reason why I'm sort of medium-term happy about the markets, because I think that is what will drive the impact. The data will die very quickly if the consumer stops, as I said in the meme today, of 70% of the economy is consumer. If that suddenly grinds to a halt, it has a wide-ranging effect in the US, which again, the bond market spots that, and that's why people are buying. Consensus is for 60 basis points off, which is 2.5 cuts for this year, and another 4 cuts for next year. So you would be placing yourself in 10-year bonds to get this geared effect, the duration effect. A lot of people are putting on the bull steepener, which is the selling of the shorter time frame bonds to buy the longer ones. That is the issue. And historically, when you start getting that steepening, that can be too late, but it's all kind of a predictor that there will be a recession. So again, the Fed needs to be very smart here about just how quickly they go. You can't, if they wait for perfect data, then they'll be in recession. They need to try and just bluff the market and the consumer into still being upbeat and not going under, not feeling like they're going to default on their loans. Remember, we had earnings season for the banks start on Friday, and JP Morgan, the best of the lot, still up their provision for bad loans. And these are the guys. Jamie Dimon, I've been harshly critical of him, but he's there. They are one of the biggest seers of all data here. So when he's saying there's potential black swans and inflationary impacts and blah blah blah, you sort of have to keep a wary eye on it. And they also see the downside of it. They see when stresses are coming in the banking system. Now, the more investment bank focused, the vampire squid, Goldman Sachs, they've updated today, and their trading profits have been fantastic equities, bonds, and capital markets. Although M&A fees are down, but they've been doing things slightly differently. They've been buying credit credit assets rather than worrying about the M&A while it was in the doldrums. So net, they're beaten. I think they're ahead. The biggest stock up today, I think, is Donald Trump's one anyway, isn't it? With DJT, the Trump media machine. Why you get all the conspiracy theorists coming out? He's done it to make money. He's done it to win the election. Well, it's a hell of a gamble if that wasn't for real. The Russian roulette, indeed. What have we got? Usman, are you long on silver? I mean, if we are going up, aren't we? I think. Gold just hitting 24.20. It's digging in after that. So the data from gold, if you looked at the CFTC stuff, that showed that the managed funds were buying it. The commercials, so the non-commercial players, against that will be kind of market makers, swaps, etc., hedges. So it'd be interesting to see whether there's any physical within all that buying, or whether the actual central bank buyers. Forget about China. India's buying it. Czechoslovakia, Serbia, Turkey. There's lots of other buyers than China still in the market at the moment. So it'd be interesting to see whether the paper market tries to take it on, and they haven't shown much signs of it in the early part of today. They've been seen off. So we'll have a look at that. We're still in the uptrend as far as I'm concerned. And at the end of the day, your first instinct when you see buy interest coming in from funds and retail is that will go until it's exhausted. So even the professionals will take that on and try and stay short rather than just literally sitting on top of it. That is creating too much gearing against you. So everything's in place for gold still breaking out. DXY currently rejecting 104.058 PAV. We've been saying all along, haven't we, for the pullback in the dollar, we need to see 104 levels got to go. So we had the little bounce up over the weekend, and I thought potentially that could have got a little bit more severe. Could still happen. So we could have more of a three wave than the one we've had. This could extend and go again. But really, as we were saying on Friday, it's all about the nesting. Ones and twos are putting in sequential lower lows. And it keeps happening. Obviously, we keep getting back. But what I'm interested in is all these downs are very impulsive, and we're back on a classic sideways consolidations, surges down, consolidations, sideways to up, surges, etc. That is classic nesting. The way this is set up for my counting at the moment is we're about to have a third wave in a third wave of a third wave of a bigger two third waves. Hold on, we've got a guest. Timmy the dog. I do think we will break through, yes. That is for sure. Just got to deal with a couple of doggy friends. What's going on? You should be near the room. Go on. Head you out. Timmy. You don't want to hear the barking when it comes when they want to get out. So they get 102.3460 for DXY. Yeah, I mean that's a kind of, we're looking at another two at least on that third wave. Yeah, I think when all these third nests come, I think we will eventually have a test of a pound again or 100. We'll look at that more when we actually break. For the minute, it's just about breaking that 104. So if we are about to get really impulsive with all this on the old setup, so yeah, I mean the sort of impulsive breakout, first expectation of a third wave, 1.618 takes us to 102.080 roughly. So yeah, I mean that kind of ballpark for you for the proper surge to come. So yeah, so net markets, bond support, the yield support. Excuse me. I was doing a dog walk yesterday and something flew in my eye. I think it was some kind of nettle pollen. I just can't do anything to stop my eye watering. It's really annoying. Powell obviously gave the big signal to the bond market with the dual mandate. That's always something you want to listen out for. We've been talking about inflation forever. For the actual head of the Fed to admit that they're now on dual mandate means they're very, very close. That means making sure employment is as full as it can be, as well as prices as low as they can be. And Goolsby seems to be the man he's sending out to bat for the Dove team. He's not a voter, but is very vocal and well respected, and is super Dove of Dove Land in Dovetown on Dove Day. And he was saying again today at 12 o'clock, reiterating that this is the path of data that you'd expect to see to lead to a rate cut. So they're very, very close. So July is probably not going to be when they get too close, but the rhetoric and the real sort of setting everything up is an event that they call Jackson Hole, which you might be aware of, which happens in August. It's a kind of holiday season wrap up for the markets, for the Fed, etc. It's highly likely the language at that, unless the data returns to hawkishness, is when they will say that job's done and they're preparing to do things, etc., etc. That's normally the market gets excited about Jackson Hole and gets let down, but this year, I think it's probably perfect timing. So I put in the weekly, a lovely thing that Yahoo Finance did, rather than me having to put all the inputs into the spreadsheet and create the same thing. They did me a favour. Where inflation is and isn't on the CPI. Now we know that the Fed follows PCE, but a lot of the things that feed into that are all in this either going down category or slowing down. This is an annual figure. So rent and housing is still elevated, but their monthly moves are down to spot 3 from having been stuck at spot 4 months. Remember, housing and rent is 36% of the headline CPI. Strip out energy and what do you call it? Yeah, the component. Brain fog. Slip out the two things that food, isn't it? Food and energy, and you're left with it being around 46%. So that is the one that you need to see breaking. This is the one that has been annoying. 20% auto insurance, and you've probably seen that in the UK as well. So it's a global phenomenon. You only pay for your motor insurance once. So it is a kind of anomaly, but it does obviously, when it's that big, it does have an outsized effect on the overall data. But at some point, that will roll off. If rent and housing are going the other way, you suddenly have deflationary prints, and it's panic time. But like medical care, personal care, that was running out of control around the start of the year when we were panicking about the Q1 data. Used car vehicles, they've completely reversed. Rental cars are down, but I know there's some rental inflation in the PPI that was slightly elevated last week. The PPI itself, that missed on Friday. Everyone thought that might just unwind the whole CPI But that headline figure was down to something really weird. It's in trade services, government, capital, trading, so capital equipment. God knows what they're up to. And I keep hearing the government is too big in the US. For whatever reason, they've been having to purchase some equipment, and obviously having gone from not buying it to suddenly coming into market, and that's brought in a blip up in prices. That's probably not something that lasts forever, which is why the market ignored it. Just like CPI, most of the data that feeds PCE was all subdued, so hence we didn't get a big sell-off on the back of the rates backing up. Something that I talked about years ago, and more people do seem to talk about now, is that GDP, and everyone looks at it in the real terms. You should go and look at GDP in nominal terms, which is prices times the activity. When it's all slowing down, because as the inflation slows down, then the nominal by definition has to go down, and then the real number starts to implode really quickly. It's very rare that you get an actual slowdown in nominal activity. So just be aware of what's going on in this Atlanta Fed. It is slowing ahead very quickly. The consensus here, you can see this. You can get this graph from the Atlanta Fed website. Their estimate is usually above the whole range of the blue chip consensus, and it started to slip into it. So by definition, I don't think we're far away from seeing some downgrades in the US to some of the GDP projections just based on that, unless this all picks up. So watch out for that ratcheting through. Listen out for the right strategy notes that are going to come out. So dollar, as we just looked at, looks to be backing up. Yeah, I've got a different picture on there. So keep in mind that we should be getting this 3 of 3 of 3 of 1 of 3. It's not, so the daddy boy would be all the threes. This is sort of the second best, really, of likely impulsive surge down. We've been waiting for that one more turn. We've kept having this consistent nesting, sideways, coming down. So net with that and the data that's coming out, UJ, obviously they've stepped in, had a little play. Just before we do that, look at this one. Which is the bond market still, this is US 10-year, as we said, is supportive. We've got the surging in the opposite direction, which tells you the thing is going to higher highs and on surging waves, impulsive waves. So it looks like we're very much in an uptrend there. I was expecting more of a pullback on the Trump situation. We may still get it. But there's every chance that this here is the end of the 3 swings. So that is a stop loss really on if you're playing bonds on any platform. It feels like we are still just on the cusp of this becoming more vertical, the gradient picking up, and the US yield support. Finally, hopefully 10-year gets a 3 handle on it, which means an interest rate yield that is below 4, starts with a 3, etc., etc. So UJ, what I was talking about, we said that we're in a position where it may flip-flop, and I've actually brought this down. We said we had an option of maybe the 3rd wave is in, 4th wave, and we may well have topped that thing out just because this whole thing is playing out on a larger scale with the way that we've intervened. That sort of suggests to you that you're at a higher degree of wave. So I've closed those off. It showed you that the 3rd wave stayed within the same channel as the blue waves. That was quite a powerful connected surge, and it's finished off. We've now done a 3-wave swing, but we have put in a tiny little lower low. So that to me suggests that we're going to do a double correction. So double of that takes it down to that previously big option volumes 155 level. There may well be supports left in there. And remember, we talk about the 4th wave, always looking for the previous degrees, which is the black waves. That's not a million miles away from the 152 support, which was where the original barrier triangle is. So there's every chance we're going to get a little bit more selling of the dollar, weakening dollar, yen advantage to it, and we're going into the July 31st meeting. And will the market get all bullish and then be disappointed, which gets us into the next leg up? That is the potential fundamental setup, I think, because they are openly saying what they're doing, and it feels like we've got a weaker US backdrop. It's a quiet week for US macro, is the only issue. So that might not necessarily happen this week, but into next week. I haven't seen anybody chat for a while. Are you all still there, or was this shut down? But she's there, never in doubt, never in doubt. So that's happening. Obviously, we've got the ECB meeting on Thursday. That is probably nothing done, other than they might start making noises. Thank you, Teflon. The Rise of Phoenix still here for now. They're not bored enough yet. So Eurozone meeting, really, it's basically where everyone's going on holiday, blah blah blah. There might be a little bit of in the background chatter about September. Now that the Fed is baked in, they'll start. They won't want to be out of line. They want an opportunity to go again. Their rhetoric has really been saying they're not going to go away on a cut without the US again. Is the sort of consensus. So they'll be finding a way to mumble swerve back in line with the Fed, which leaves us a problem with the Bank of England, because we've got crazy horse Catherine Mann saying she just doesn't see it, and there's just services inflation everywhere. Well, they'll end up with services inflation and a recession if they listen to her. Pill is a kind of economist that will try and be balanced, so he's kind of slightly hawkish, saying it's when, not if, but need more data. And Haskell wants to be a hawk, and he's probably secretly in love with Mann. And so they're all stuck together on the hawkish side. So Bailey's got his work cut out, but if not careful, then the Fed are going to be going in September, the ECB again, and suddenly we start getting out of line, which is why there's an underbid to sterling. But be careful with the CPI, PPI, RPI on Wednesday. Everyone's revved up saying it's going to be services sticky again and again. They've been really sticky for the last two prints, but the index of services, which came out about 10 days ago, was really, really upbeat consensus in those, whereas the last one that came out was only a 1.1 versus expectation of 1 print, no real growth from the previous one. So if there's going to be a period where we might just get an intra-month pausing in UK services inflation, it could be this one, which would be ideal for Bailey to turn 2 or 3 heads in that August meeting. Obviously, I think they would have potentially done that if the election wasn't in the way. So any excuse, then that's when they'll come in. In the meantime, I think sterling is bid, subject to whatever is going on with the dollar. We're expecting that to come off. So again, we don't want sterling to get too strong, competitive basis. We'll see what happens, but the economy over here is just teetering on the brink. Construction was good the other week, but manufacturing was really poor. Industrial production was all right, but the export-import mix is a little bit the wrong way at the moment. So we do need to get things chugging along, and retail sales are dreadful. And talking to people in the last week or so that are on the high street, they're talking about footfall being appalling, even despite the slight blips from the English football, etc. The weather being dry, not necessarily warm, unless you live in Scotland, Julie. And I don't think people are necessarily going out to play. Having said that, I've just started. That's it. Pitter patter. I've just started the rain here. Well played, Planty. So DXY strong, UJ just showed flip could double, and then I think the euro and GU are both sort of playing along with this same play really on dollar weakness and sort of on hold in the background, improving fundamentals for Europe while it's gone quiet with the French politics. So we could be grinding up here. Let's try and go to the real chart. So yeah, so again, remember we didn't take out that low. We've been grinding up in ones and twos, kind of mid-move on a third wave here, which I think takes us to that sort of 110 challenge, which then consolidates, and there's going to be a lot of choppiness, which takes us into the end of July. Do we then get another issue with France? Again, we'll have a look at the central bank meeting calendar as well when it comes up, but with both of them, with building that there's a September cut for both of them, then you start to see the relative disappear, and then it comes down to the fundamentals of the currency. Around here, there might be some French shenanigans. They're already threatened to be downgraded again by Moody's, subject to how the Parliament gets decided on what the fiscal policy is. At the moment, we've got Jean-Luc adamant that it's got to be super debt. I mean, the irony being Le Pen's lot was even less fiscally scary than the current setup in the middle, and it has been a ridiculous bit of horse trading. Macron's got to pull a few things out of the fire there just to keep France from being super downgraded and having all sorts of issues which will cause palpitations again for the euro. So that might be where we get that consolidation wave in, etc. So Bletchley, you've got 133 on GU, which, funnily enough, look at that. Yeah, so I'm kind of expecting this current move. We're in a consolidation here, which might break out at any point. It could be a double, but I think it's going to be a short one. And I'm looking for the breakout for the end of this third wave into the 131s, consolidation, and then there will be another high at least into that 132, 133 region. So yeah, I think we're on the same page for the minute on that one. Just literally how we play. So it might be that we get a muddling set of data midweek that is still all right under the hood, but it's just enough to keep the market, 50-50 split as to whether they'll change. That will keep the bid under GU and associated. Potentially, the Aussie dollar is maybe the most aggressive, isn't it? Because they've got the 6th of August potential. There's still potential rate hike there. Look out for the employment figures Wednesday night, Thursday morning over here in Aussie. They need to see some data really go their way, or there's small panic on, and people on the data on mortgage approvals and housing starts and stuff is very, very mixed. People are suffering in Australia, and their economy is just out of line with everything else. They still haven't got it totally under control. So yeah, I'm just looking at my chat. Edward's asking if we can make a chat for indices traders, because we do get a lot of people doing gold on my chat. And I mean, how many of you guys here? A lot of you playing currencies and gold. Does anyone play indices? Yeah, just back sterling. So I think we're in a nesting within this 1-2. So we should have another third surge consolidation, 3 consolidation up to that sort of 132.33 level. A good Bletchley, you play everything. Good stuff. So I suppose we'll go. I'll just go back to preview and see if there's anything else I put in there that is super interesting. All of it, obviously, all of it. So I actually put in a little table in there just because I was fed up of moving around and to look elsewhere for it. Just at the next 4 meetings, the main central banks. So we've got the Fed at the end of the month next week, alongside the Bank of Japan. So that'll be a busy day next Wednesday, or is it next Wednesday? No, 2 Wednesdays, isn't it? Bank of England on the Thursday, the next day. ECB this week. People's Bank of China, they don't do any meetings or they give very little commentary, but we know there's lots going on and look out for support measures coming. Swiss Bank, they had PPI fairly flat today, so the underlying pressures are still there to potentially keep the market guessing, but they might have the opportunity of cutting again. So do we want to get it down? This is the big boy, August the 6th, Royal Bank of Australia. We had the Royal Bank of New Zealand last week, didn't we, when they changed their rhetoric and they really brought forward the potential for the rate hike into the start of next year, if not November, so a rate cut. And then Bank of Canada next week. September, again, there's lots of them around the same period. Royal Bank of New Zealand go again in August. It's only them and China in August, really. Obviously, UK was the very start of it. But lots of things happening around the 18th, 19th, 20th. Remember, August, September indices particularly tends to be a bit of a sideways, if not sell-off period. So it might be that once we get to the top, this 3, 4, 5 we're playing at the moment with indices, once that's topped out in the start of August, we might go into a bit of panic. I don't know what's going to cause that, but historically, seasonality suggests that is a weak period, and then we might be into the rate cut rescue into September. November, remember November. November the 5th is the election date. They start their meeting on the Wednesday, and the Fed comes out on a Thursday night in November, 2 days after the election, which will be the same day as the Bank of England that month. The Royal Bank of Australia will be on the US election day. So, big week. The first week of November, keep that in mind for lots happening. But anyway, that's good. You can always come back to that and find it pretty easily. And then indices, which we'll have a look at. Yeah, Guy. No fireworks here. It's very tempting. Very tempting. The Guy Fawkes references. But I've held it in check. You'll all be pleased. I will have a look at some indices now, and obviously all sorts going on under the hood for why. We've been expecting it, haven't we? We've been talking about if we get rotation from large cap into small cap, or even throughout the S&P, the S&P would probably come off, and the rest of the stocks would rally. It's just perverse. It's just perverse just how heavy weighted the big boys are. So I think there's only 2 sectors really outperforming. Obviously, the tech and communications. I think it is for the year. The top 5 stocks are now 29% of the index in the S&P. The top 50 are all up 13% this year. The bottom 50 are down 12%. So it's just a case of people probably barbelling a little bit there buying the top end, selling the bottom is probably a strategy that's made some people quite a lot of money. But some interesting things ahead. We said we're going into the earnings season that's started, and this week one of the more fuller ones than of late, and the expectation was for 9% overall for the S&P. That's running quite high. But underneath what hasn't been performing, breaking out, has been the other 493 away from the Mag 7. But Bank of America put this brilliant bit of research out. The expectations for Q2 earnings growth. Look, the little blue, light blue ones, it hasn't happened since Q3 22, are set to actually grow in this Q2 24. So that's the first time for 7 or 8 quarters. That is interesting because that means people will be looking to try and own that momentum, and the forward forecasts are for the growth 7 and the market as a whole to be closer. That's perfect for rotation, perfect for breadth, the one we haven't had for actually coming on. So for a while, what that can do, and we've had the first 2 weeks of July, which has been positive, out of the way. Every chance this consolidation happens, even though we're going to have positive flows and positive updates from a big part of the S&P, but it's starting to be a case of net overall that 9% needs to beat underneath the hood. There's more encouragement for people to invest their money, so hence money's coming out of money market funds to be put to work in bonds and in a wider spectrum of US equities. But if you want performance, if you just blindly buy the index, you might not get any performance. Unfortunately, we can't buy stocks here. This is something that I've always talked about, and other people do over the years. When the stock market isn't really moving anywhere, it becomes what they call a market of stocks rather than a stock market. So you go down to the literal alpha, like Alpha Capital, try to find the alpha on individual stocks until we get to a time where all the index is moving again at the same time. Edward Ogas, sorry for interrupting the show. That's Edward on the chat, isn't it? Yeah, no problem, mate. We will look at that. I've got problems with threads disappearing after a month. I can still find them. I think hopefully make them return. Otherwise, we'll get a little sub chart room put in. Hopefully. So that tells you what's going to take. A good sign of that is what we saw on Thursday when Russell was up 3%. I think it's up 6% a week. The S&P on Thursday was actually down, but outside that, 400 of the stocks, S&P was up on Thursday, with 100 down, but the heavier weights. We've been waiting for weeks, haven't we, for the advanced declines to come down. Sorry, you weren't on that. We having a mare today. So this is the chart I was talking about. The blue lines within the expectations from Bank of America. We had a 493 S&P 500 minus the Mag 7 positive earnings, blue lines. So that gives you confidence that we're about to start seeing some breadth. That came through with what I just described. And they saw 3 powerful days, Wednesday, Thursday, Friday, of advanced declines in the S&P and the New York Stock Exchange as a whole. What did we say might happen on that? We said that the S&P equal weight would start to outperform even if the S&P was going sideways. We put in that contracting triangle, wedge, flag, however you call them, last week, saying we expected that potentially to break out through the earnings rotation if it came. And look at that, I actually got something right. Boom. There was the first downgrade on Nvidia last week, which was obviously going to come at some point. But I'm not too concerned with Nvidia, because if you look at them, their forward price earnings ratio hasn't really moved for the last couple of years, but their price to their earnings have gone up, their price to sales have gone up. So that is why that is That is what happens when a stock is growing. So if you're worried about it, the multiple would have gone up. People would be paying silly multiples relative to what the earnings are, and they're not. So Nvidia potentially isn't as overvalued as a lot of people say, but we are getting some natural profit taking. And the one that we need to watch out for is Apple, because they're coming out with good noises and their market share, I think, in India today was good. And the China one is better than the disaster, but the Chinese phones are taking over. They've got this new phone and the AI operating systems coming. They can go, but the Goldman Sachs showed that on just about every metric, PE, EV, EBITDA, price to sales, Apple is trading at twice its 10-year average. So that is an extended stock, and obviously very heavyweight. And funny enough, that is the one that was shifted down in the XLK in terms of weighting. So they probably got it just about right in terms of that one being overvalued. But on an individual stock price basis, that's probably yet to have an effect. So whereas Nvidia might not necessarily be the one that collapses from here, don't rule out Apple coming back a little bit in the next couple of months when the market slows. But you know, they might update in a way that justifies that. They might grow into those ratings. But just be careful. That is one stock that does look like it's flashing red hot. The issue of will this kind of rotation continue? Why did people jump into the Russell, the CPI? Generally because a month before the first rate cut in the cycle, small cap outperforms. And we're talking about September being the first rate cut. So we might be a little bit early on that by a month. And then once the rate cut cycle starts, after 6 to 12 months, those lower rates really start to help smaller companies. They can start breathing, can start borrowing, expanding, etc. And that's when they start outperforming. So we're probably going to have a short-lived rotation period, and that sits nicely with what we described of selling will stop in those, but whether people carry on buying them in exchange for the larger growers is another thing. I think once the rate cycle starts, people start going back into the larger caps first, and then they start doing their diversification from there. But they don't want to miss out on any gains. And that's something that really does happen in the institutional world. People just want to get their money into the market, so they go for the most liquid, often the futures or the bonds, and then they do rotations, try and trade on baskets, really, program trade, so they can get everything swapped at the same time and take out a lot of execution risk, which is often why you will see support and resistance in the shares that you couldn't have anticipated, and just all the blocks in the way, you go, where the hell did that come from? And it's literally because someone's printed an absolute outsized trade in a number of stocks at the same time, and the market makers have to work out of those. It pins the index while that's what happens if you either buy or sell a load of stocks. Then equally, market makers will hit the market with futures to hedge first, and then unwind that against the stocks. So this is one of the reasons why, when you're in these rotation periods, you get quite strange price action that you find difficult to understand. So that is that. We'll go through some of the indices in a minute. So yeah. The other thing that's interesting, I say this consolidation could continue for a few days. We haven't had a 5% pullback in the S&P for 220 days. It's been close to it, but never quite done it. The longest stretch is 550 days, and that was in 2016 to 18. So if you keep thinking, I'm going to buy this on a 5% pullback, you've been a long time waiting. The irony is always that you go and buy it now and you get your 5% pullback. So patience if you can. There might be this little top to come, small top, get consolidation, and then you get a chance to buy in. Talked about the banks, some of their indices, some of their underlyings, net interest margins weren't as high as this should have been, expenses were higher, and provisions for loans went up. So Citi, Wells Fargo and JP didn't really go anywhere on Friday. Bank of New York, Mellon did beat a lot of their metrics, so they outperformed. We've had Goldman's today. NASDAQ-wise, Google over the weekend, set to do its biggest ever acquisition, 23 billion for Wiz, a cybersecurity firm. Is that a sign that the market is topping? Are they going to be using? We need to look at the details more on that. If they're going to be using their paper and no actual cash, then people might start questioning that as being a top of the market use of their share price. But for the minute, we'll give them the benefit of the doubt that they're just expanding into a big tech breakout. And again, I think the Dow of all the indices looks like it's most near the top short term. And again, could it be that Apple that just starts to see a bit of selling if this rotation continues? Anyway, we'll go through those charts one by one. Is there anything else? Oil, yeah, we'll have a quick look at that. And then the volatility indices. So I said you need to look at the volatility. It's been quite benign. Some people are saying, is it getting greedy? It's not a million miles off, but we are getting back down towards the lower of the trading ranges. Bonds have lost their volatility. VIX is dropping down. CVIX, which is the currency volatility, and lots of you have moaned that there's just no movement going on. That again is down. Generally, people look at that and go, well, that has to reverse. It means reverts over time. So it's another sign that we may be close to some consolidations and a bit more movement around new currencies. Within that oil, OPEC obviously are the most bullish, and they should be after all the cuts they've done. America, I think, I don't know whether I've ever heard it before, so I might have heard it properly last week. I'm sure that their production number went above US oil consumption for the first time last week, and they are still pumping like crazy. They're filling in a lot of the gap for OPEC, but even the ones that have backed that view, the IEA and the EAI, both had reports out last week, both sort of saying that their demand view had gone up slightly for the year. OPEC left theirs as being the biggest demand outlook. Now, all of those were done before the Chinese trade data, so it might be that they might revise those now. Either way, there's going to be a demand-supply deficit, and there's probably going to be one in 25, but not as much. It's all according to most of those reports, they're all going to be fairly flat going into 25, and by the middle of 25, when OPEC can turn the taps back on, there'll be a surplus. So all that points to potential near-term top. Still a little bit more to go. Maybe Brent could possibly get to 89.90. I'll show that on the chart. But then I think the combination of the demand maybe not being as great as everyone anticipated and starting to price in forward into 25, we might start seeing a little bit of consolidation of that move, at least, if not back into the sell leg. I don't know how many of you play oil, but that's just starting to get interesting again on the fundamentals and the technicals. And then again, we'll look at gold briefly today, just because we're still churning in what looks like a nesting period. So I'll just run through those charts. DAX, I still love that. Again, is looking like it's churning towards one more new high here. That could be anywhere, and I do think it'll probably try and re-enter the bullish channel. We've just got this overthrow for the minute. We'll have a consolidation of this whole move we've had, just all part of this choppiness at the end of July that we're anticipating early August, and then once that sorts itself out, we're into a third wave breakout. So where could that be? I think possibly back to 19,000 in the short term, possibly a bit less, 18,800, 900 if it struggles with the retest of the channel. And then this is where we're looking to buy it. So we're in a situation a bit like the Nikkei a few weeks back. You could buy it here, but we're in the middle of potentially a good buying opportunity. It's just trading, short-term trading only there, and you can take your pick. Needs to put in a new high. So you've got a trading short if everything's looking iffy, or you've still got 200 or 300, a couple of percent of upside. And the problem is you don't really know where your support is on that. Potentially this 50-day moving average is a retest just a little bit below here, so maybe have that in the short term as a support, because even though I'm looking for one more high, that has got a valid top in, so he could be into the sell-off. I just don't want you to wear it all the way down there, but I want to see you buying it closer to the pullback. So yeah, 50-day moving average probably is a buy stop loss, and if you want to sell it, obviously a new high for the move in here is your issue. Nasdaq, I'm only showing you this one because I know it's very messy, just flipping through. Just the fact that it's showing you that we are at the top of the bullish channel for wave 5 of all the red. We've overthrown it and we've pulled back in. We'll have a look at that on the hourly basis. Potential for one more tiny little high in there, but if anything, this spike up could be the short-term line, short-term top. So on the hourly basis, I'm treating it that we've got potentially one more top to come, because we've got the 3, 4, 5, but we have broken out again of that channel. So we could easily have 3, 4, and have put in 5 there, which is just sort of saying. But on the hourly gradient of that channel going through 2, 3, 4, still takes. It's not. I normally like to see these overthrow or at least touch the top of the whole channel. So I suspect that we've got one more high still left in us. But again, it's tricky. This again lines up with potentially the end of July, August being where we eke out the top, and then this, wherever we start this 3 for the 4 pullback, is where it starts to get serious. So we are, Edward, still slightly bullish, but we're in a lot of sort of temporary consolidation phases, as we're just starting to walk through them. If anything, like the DAX, I said I'd prefer to buy that if it did pull back. At the moment, that looks like it might have one tiny more new high left in it, but it could have finished. Equally, the Nasdaq could have faded the channel and finished here. Easily do a double, but for the moment, I've got to suggest that this is 4 here. That we just starting the grind up for properly topping out here sometime towards the end of July. The favoured most bullish stance to take until it breaks is that you're still in the upside until it's not. So I prefer to see that as the setup. So we know we've got here a stop loss for buys, and again, sort of mid-range, with stop loss for sells at the previous 3. So for the minute, it's a coin toss. And that's what I'm saying. I think at the moment, while we've got this rotation going on that we've been discussing, these are the heavyweight stocks in the Nasdaq and the S&P. So it doesn't take a lot for these indices to go sideways and down, even if they're still overall bullish. The setup, they're just doing market cap consolidation, if it were. All depends. I mean, it's the next couple of weeks when the big tech start reporting. At the moment, unfortunately, I'm just saying that is mid-range. If we come further back here, then I would have I'd look to be buying it. Small stop loss. We're halfway between the 2 at the minute, and it's not clear. The action isn't clear. It looks like it's nesting, but that could easily just be nesting to downside as well. Sometimes you've got to say, I don't really, not confident with where that's going because we've got past the first 2 weeks of July. The second 2 weeks generally are positive, but only small positive, nowhere near as much as the first two. So I don't rule anything out at the moment. Again, I know you love a messy chart, so I've got one for you. The S&P 500. I just leave this chart up with all its lines and squiggles, and just to invite people on, like they do on my chat, to get abusive, just about colours and lines. These are the key things. We talked about it on Friday, and it's carried on. This is a number of stocks above the 200-day moving average, so that is zooming up. You'd expect that because remember, 400 stocks started bouncing on Thursday versus the 100 down that brought the index down. That momentum has continued. We're grinding out here on relative low volume. Rotation money coming out. Is that going to be enough to make us surge on? There's every chance, as we just discussed with the mechanics, volume starts picking up. This starts selling off. It may have one more high in it before it comes off, but we've got this consolidation period ahead, and then we've got another decent bounce. So potentially not far away from a trading sell, and that might be into, like I say, this positive rotation. It depends on the earnings. The earnings have got a really high hurdle to get through, and then as we get towards the end of July into August, it's all about Nvidia time, expectation going into that, and then after this fifth wave here is in, this is the end of our whole 3, 4, 5s that we started down here. So we're right at the top of the blue 3, which was the end of this 3, 4, 5. We're always expecting some choppy finish, and then that sell there is when you're going to get a decent sell, which could be 5,800 back to 5,000. The one that everyone's been waiting for. But in the meantime, we can have some trading opportunities, I think. So just like the S&P, the hourly is slightly like it. We're still in the uptrend, still running up. Has put in a very tiny higher high there, so there's every chance that this is 4 here. Again, it needs to put in another high to show us that we're moving into the end of this fifth wave, but we're not talking about a lot here, 5,600 to 57, maybe 1 or 2% maximum upside, and then a pullback generally to the other side of the channel for the fourth wave of that, and then finishing off at the fifth wave and the red fifth wave, etc., etc. I've not got them on here, but that will be, as we just said, potentially up around here, 5,700 to finish. So a bit of choppiness. Again, we're mid-range. It's hard to say where we are. So again, you can short knowing what your high stop loss is, and you've got your lower low down here. Do you want to be playing its mid channel? Probably not extreme enough yet. Don't have to have a position. So again, this is the one that not overly convinced about yet. That'll be over here. Again, it has been the laggard. We're just beginning to put in higher highs, so that is kind of suggesting we are in this fifth wave. Probably puts the one in here, and then this could be part of the consolidation, or it's a set of nests that are pushing out. The fact that we've now got high leans me towards the fact that we're in small breakout there. So the Dow Jones, that's still got Apple in it, hasn't it? I think. So the caveat of the Apple weakness, but if we're going to see rotation for a few days into other industrials, other powerful stocks, it's all about prices in the Dow rather than the market cap. So you could have a situation where Apple is weak, but it doesn't have that much of an effect on the Dow. So this could be about to play catch up with the other two in terms of its finishing. So that again, we've got there 38. It's not good because that's a 5%. So maybe there 39.2 as a stop loss maybe for a buy, because you'd be back out of the channel and you'd be challenging what looks like 5 waves in place. So you might be consolidating. That would tell you that there's probably more to come. So the Dow's a potential. So I don't think there's not enough in there to say that the 5 wave move's finished. Well, it would be a fifth wave ending diagonal with overlap if you had a 1, 2, 3, 4, and there's 5 subwaves in there. So that is a potential weak top. So you could drag that down there, and it's ending at the bottom of the channel. The only thing is, remember, 2, 3, 4 is normally very, very accurate for the channel, which makes you feel base case has to be that it's going to go up there before it finishes. But there is a valid end point in there. It's got overlap in the 5th wave. Thank you, Rise of Phoenix. See you again soon. So yeah, the Dow, just keep an eye on that, because that has got the potential for an end, but it is showing tiny bits of impulse. I just don't really, I don't know, you're probably spotting, I'm not really keen to buy indices at the moment. I want to buy them all at pullbacks, which puts me in line with you're going to miss that. I'd rather not walk into a 5% right-hander at the moment. So we've managed to call this fantastically from the bottom and in the intraday top the other week, saying that was going to put in a 5th wave. Started coming off on Friday, and it's every chance it's going to do double here. We said it would be a test of 40,000. Already failed to hold the 50-day moving average, which is what it was following all the way up. As you can see, through it needs to regain that quickly for us to for here. So everything is lining up for 100%. About 40,000, and then we buy. So far, this index has been trading like a dream, and we've been calling it like a dream. So again, we're absolutely mid-range between those. You've got potential for you could have a sell here with the 50-day moving average as a stop loss. It's possible that this does a double itself that challenges that, because that index is going to be coming down by definition with these lower prints rolling onto it. Yeah, like the Nikkei, we've still got a 4-5 to go in. We could have had the 4-5 to come, but let's buy it cheaply. No change to view, particularly there. FTSE dog, that has obviously still wait to see the real detail of the Labour policies. The inflows have been rubbish, which we talked about the other day, but they have put in WXY. That was a low and it hasn't been taken out yet. So it could be 1, 2, 1, 2, about to break up, or we might actually just be extending sideways movement from the X. There's every reason to expect that to have another down leg there. So we might not be done with the FTSE yet. I keep saying I want to catch it on a pullback, keep missing it, can't get it down to 8,000, but still got that in mind as being the WXY 100% level. So what we're doing again, we've got the 50-day moving average holding us at the moment. We've had 3 failures at it in the last 2 weeks. Is it going to be held again? So we really need to see a close above that 50-day moving average really to get the impetus going. So keep your eye on that because we might not be into this 5th wave yet. That's on the daily basis. Where's the hourly? So by definition, that 2 goes there. We've had a lower low, a double. Is this? Are we in the 3rd wave, or is this thing just actually a WXY? For that, so we'll leave it as the nest until if this breaks, we're moving 2 across. And if this breaks, we're moving this 2 across. In the first instance, we're still going to get every chance, but it may well be that we are moving our way down to this 8,000 challenge, as we just showed. So again, I haven't got the moving average on here, but it looks very much like we've been failing over here. It's 82, 85 is your stop loss for sells, and your stop loss for buys doesn't give you a lot of room there. I mean, if 81.92 breaks, then we probably are going down another 0.5 to 1%. So just be careful. Again, we want to see it at the extremes. We want to see a high or a low, or one of these 2s properly holding for the next breakout. All really annoying, isn't it? They're all slap bang in the middle in the way. And we looked at S&P equal weight. Let's have a look at Nvidia. See if I've not looked at that for a while. So we were trying to decide before, weren't we, where the 3rd wave performance was. So the next, if this is just a short-term pullback and Nvidia goes, then if it goes bigger than this middle wave here for its next upside, then we've got a big extension coming. But at the moment, everyone's getting very excited about the pullback. Again, Nvidia looks held by its 50-day moving average, doesn't it? It failed there when we started the February-March pullback, which ended up, this has been recalibrated, but it was a 20% pullback. And what we had so far, we've had a 20% pullback. That one, remember alternation, which I talked about before? When you get a choppy sideways movement, you tend to get something that is much lower in size or duration, and this one is very, very quick, shorter duration versus this one being choppy, and they're both the same size, so there might be a little bit of symmetry in the size. So this could easily be a 4th wave consolidation, in which case this is building for at least a new high back above 100 at some point. Ironically, from this is Nvidia. We had this setup talking about what the 3rd waves, what could be the 1 and 3 wave previously, and we were saying that it had to have the final wave when it comes not exceeding what this one here is. So whenever the down point is for the current sell-off, that movement has got to be below this, which is 85%. Obviously, we're starting from 80, so 80% of that is, so we're looking at 140, 144 as a top. Obviously, if that happens, the market's gone a lot higher already. That moving average is up there, so they have to retake and hold its 50-day, which it hasn't managed to do for very long of late. So if anything, we're expecting this to potentially grind higher here and fail at maybe 110, 115 NVIDIA short term. If we've got some kind of large cap rally going on in amongst this 345, then it's all about what happens in NVIDIA's earnings. Well, again, if we've got there in advance, that's travel and arrive, we have to have a very upbeat update for us not to go into consolidation again. So that's interesting. I think that is potentially 80, 85 is a line in the sand there. So if that breaks and you're doing a double, then you're coming down to 25 from there, down to 75, 80 at least. It might go a bit more. But yeah, keep an eye on NVIDIA, obviously, as we have to. The final one before I let you all wake up is what I was talking about in Brent. So since that May top, we should be into 5 waves down, which takes us into weakness much later in the year, which we're discussing about how the forward-looking demand-supply situation looks. But in the short term, obviously China's not helping at the moment, which the trade data last week brought us down here to a challenge, but it didn't necessarily break it, did it? Right, in which case, I think we can move that over here. We had a very tiny break, so we got an expanded flat for the breakout. It had a new low in it, so we're consolidating here, which is hopefully 5 waves up. As a C, probably doing 1, 2. Going to grind up potentially as long as this holds. If not, might just be a further extension. What you'd normally get is a much bigger drop off for the final leg of an expanded flat. It's theoretically gone past previous low, but only by a smidgen. So this could easily break a little bit further down here before we go again. So I'm in a bit of a confused state until this sorts itself out. Net, there should be a C wave left of 5 subwaves, which takes us to 89.90. But this is all being caused by the China demand implosion short term. So keep an eye on all that, because that could easily give us a little pullback to low 80s on. This is Brent, not WTI, by the way. At the moment, I still think we've got a tiny bit of upside left, which is relatively good upside, isn't it? It's 5 or 6%. So hopefully all that makes sense. Are there any other questions before I wrap up? I'm not going to do a risk review with someone at 3 o'clock, so I need to prepare for that. Thanks for listening. Hope the preview is useful. It's a less macro intense week, but there are little interesting things in and amongst it. There's some useful charts within there for some of the fundamentals, etc., etc. So take care, be profitable, and scale in, scale out. We haven't got to be full port all the time. Thank you very much, everybody.